Ardmore Shipping went public last month at $14 a share. The stock hasn't drifted too much, but the company's CEO Anthony Gurnee is here because he has big plans. Welcome, Anthony.
Thank you, Greg, and happy to be here.
All right. So tell me about your fleet. I think you have 8 ships now. How many more do you plan to add now that you've raised some money?
Sure. Well, we have a total fleet of 20 ships. 8 are currently in the water. The next two actually deliver in January. So very soon we'll have 10 in the water and 10 on order. And these are all mid-sized product or chemical tankers. They're all highly fuel-efficient, eco-designed or eco-modified, and they're very highly in demand by our customers.
So you get good gas mileage when delivering other people's oil and gas.
That's right.
All right. Yeah. So are you getting higher or lower rates for them right now? And what does the Syria situation do for rates?
Mm-hmm. Rates are gradually ticking up. This is a seasonal business, and rates generally fall off in the summer months when there's a little less demand activity. But we're seeing rate activity and rate increases at a time that we wouldn't expect it right now, ahead of what we call a winter market. So there are a lot of signs to be very encouraged about the rate outlook for the winter, and we could end up with a very, very strong rate environment this winter.
Is this slight uptick in rates have anything to do with Syria? And where are your routes? Are they going to be impacted by what we see in the Gulf?
Yeah, no, I think Syria is a very interesting point to make because it's resulted in a very, very slight uptick in demand overall, and it's resulted in replacement diesel coming from the U.S. Gulf, actually, all the way to Europe to replace what's not coming through the refineries in the Mediterranean. And so that relatively small increase in demand has actually resulted in a significant increase in rates, perhaps 30 or 40% for that route. And so for us, that's a signal that the market's already very tight. And when we get into a full winter market, rates could actually move up significantly.
And what's new and different about your chemical tankers?
Mm-hmm. Right. So of our fleet of 8 right now, 3 are chemical tankers. These are commodity chemical tankers, and they ship organic chemicals over relatively long distances. So, for example, 2 out of the 3 are loading and shipping organic chemicals from the U.S. Gulf out to the Far East. So they're essentially more sophisticated product tankers that carry a broader range of cargoes, and they're able to reach into the chemical world, which has a very exciting outlook because of what's happening in the U.S. Gulf, in particular with shale gas.
And then finally, you're reaching a little bit deeper into your pocket. You pay a 40-cent dividend per year. How sustainable is that? How safe is that?
Sure.
You feel comfortable if rates move down?
Right. Well, we believe that we're coming out of a trough, out of a cyclical low point. So we don't believe there's really a lot of downside in terms of rates. Rates are perhaps up 2,000, but they're still $15,000 a day below the last peak. And every $1,000 a day move across our fleet results in 40 cents a share in cash flow and earnings. So we're very comfortable with the dividend policy we set. It'll certainly be very manageable once the full fleet delivers, and that's without an increase in rates.
All right. Yeah. Anchors and dividends away. Thanks a lot for coming,
Thank you
Tony.
very much, Greg. Thank you.
And thank you for watching The Street.